Hello again and welcome back to London. The US government shutdown is extremely boring, but it is also extremely important. And I've been speaking to James Hughes from Alpari about the situation. The US government shutdown, we've been here before. It's very boring, but it's also very important. So where do we go from here? Is it going to be a case that the Republicans are just going to have to back down?
Well, it seems that way at the moment. It seems that neither side are going to back down at the moment, but of course you have the big swaying effect that the Democrats are in power. So, I mean, that issue aside, it does seem that the Republicans are going to have to move somewhere. Overall, it doesn't seem like they are looking to change any view whatsoever, and this could really rumble on for a long time, which you say is a fairly boring answer to it, but unfortunately it's the reality at the moment. We don't really see much movement either side, and the markets are even becoming a little bit numb to it now. I'm very surprised that we haven't seen such a bigger sell-off in terms of equity markets on the back of this, but of course we've got 8 days or so left until the real big story happens and we get to the debt ceiling deadline.
Do you think the most likely outcome is that they'll just kick the can down the road, that they'll raise that debt ceiling further, and then they'll have to make a decision again 3-6 months later?
I mean, looking in the history of US politics, that is the way that they tend to do things, is come up to a deadline, move the goalpost, change the deadline, move the debt ceiling higher, and then hopefully something will have changed 3 months down the line when they have to deal with it again, which is really a terrible way for the markets, for the reputation of US politics and the country itself. The fact that we continuously get into these situations is really damning for both parties in the US and the US itself. And the one thing I find really which must be happening is that the ratings agencies must be keeping an eye on what's going on. The US lost its AAA rating last time because of dallying around decisions and political infighting, and the fact is that we're doing exactly the same things again. There is no lessons being learnt from anything, and the ideological differences in the parties are having a huge effect now.
Speaking of tedious, drawn-out decisions, obviously this has an implication for tapering as well. Do you think that that's going to weigh on the minds of the Federal Reserve members as they make the decision about scaling back that bond buying programme?
Well, I think it has to. Number one, it can't be ignored. Of course, the debt ceiling discussions are huge ones. But you've also got the overall problem that Ben Bernanke will likely leave the Federal Reserve chairmanship at the end of the year. And if Janet Yellen takes over, who is currently the front runner, she's even more dovish than what Ben Bernanke is. So if we don't see any form of tapering, and that decision could be swayed by the fact that they may not do it now because of the US government shutdown and what's been going on, then we could get to January or further into 2014. We have a new, more dovish leader of the Federal Reserve who won't do the tapering anytime soon either. So it could be that this political shutdown, government shutdown, is pushing tapering further and further away.
So what about the trader implications of this whole event? How do Forex traders profit from this?
So dollar CIS, we're seeing a key head and shoulders level, and we're breaking out of that neckline at around 89.40. If the market then falls lower than that, we've got targets falling all the way down lower if the dollar remains to have that weakness. And on the other side, we've got Kiwi versus US dollar as well, which is currently looking to break out, and a key level where the 200-day moving average is 81.80. Again, any movements close to that level are going to cause some big movements. So it is giving clients and traders an opportunity to get into the markets, and that uncertainty is breeding volatility. It's not a good thing for economies, and it's not a good thing for governments, but for traders, the volatility that uncertainty brings can offer a few opportunities.
Well, thank you, James. We're going to turn our attention to the Eurozone now, which has been gliding under the radar due to all the shenanigans in the US. And I've been speaking to Alpari's Craig Erlam. At the moment, there only seem to be, if not good news, then news of stability across the Eurozone. What's next for the common currency? Are we waiting for a new crisis?
Well, I think what we've got to become accustomed to now is stagnation. We are seeing small amounts of growth right now, but I don't really see that as something that's going to be sustainable. I don't think we've got rid of all the issues that are there. I think there's still going to be at least a couple more crises to come, and then a few more smaller issues along the way. We only just saw over the last couple of weeks in Italy how easy it is for what looks like a relatively stable government, even though it was never going to last years. We saw how quickly that could turn around, and all of a sudden we had Enrico Letta in Parliament, in the Senate, looking for a vote of confidence, where if he didn't actually receive that support from the PDL party, the entire coalition, grand coalition, was going to collapse and we'd need a new round of elections and more stalemate. So I think that was a little bit of a warning for us that things can easily go wrong once again in the Eurozone, and we really need to stay on our toes. But like you say, it is encouraging right now. We are seeing countries exiting, returning to growth. We saw France return to growth in the second quarter. Spain looks like returning to growth in the third quarter. So it is all looking positive at the moment, but we've still got a budget to agree with for Greece, probably a third bailout with some more reductions on the amount of debt it has to pay back and lower interest rates and things. And there's still plenty of other countries where things go wrong. Portugal's another one of them, which we had issues with earlier this year, again politically losing support from the public in relation to this, to further cuts in spending. So I think there's still a lot of issues still to come, but right now we've got to be happy with what we've got.
Let's go back to Italy. You said that it was a warning sign for the Eurozone, but at the same time we didn't see a great sell-off in the euro. If that had happened 3 years ago, we would have seen a dramatic downturn in the euro rates. So what does it say about investor sentiment that now, when we do get a crisis in the Eurozone's third largest economy, that the market seems to shrug it off?
Well, I think that's an interesting point, because it's something we saw a couple of times this year. We saw with Cyprus the potential for that to really spread throughout the Eurozone, because that was the first bail-in, and we were talking about how weak the banks were in the Eurozone, and yet we didn't necessarily see the panic that we'd seen over the last couple of years. We saw Portugal in the run-up to the German elections. People thought there could be a bit of panic around that, but we didn't necessarily see that reflected in the Eurozone, and I think it probably is just a sign that we are becoming a little bit numb to these kind of issues, and maybe we finally have some kind of faith in the leaders in the Eurozone to resolve the issues without widespread panic, or at least that's what we can see at the moment. Although when we look at Italy, we never actually did see the breakup of that government, so we never really saw it tested to the full. Silvio Berlusconi essentially lost the support of his other PDL members who had originally resigned, who then gave their backing to the government, as did Silvio Berlusconi himself. So I think, if anything, what we've seen is quite a positive sign there, that Silvio Berlusconi isn't really running Italian politics anymore.
Let's talk about the euro-dollar, because obviously that's the most traded currency pair. Where do you see that pair moving? Obviously you've got two very different stories on either side of that equation.
For now, I'm still quite bullish. We're trading around 136 at the moment, I think it is. I think 137.10 is going to be quite a significant level for the pair. And above here, if we can break above here, which I'm not necessarily convinced at this stage we can, then we could see a push towards 140. But somewhere between those two levels, we're going to have to see the ECB intervene and do something to weaken the currency. It doesn't look like it's going to be an interest rate cut anymore, which is what was being discussed earlier this year, or a negative deposit rate, which was another thing that was being discussed. I think we're more likely to see the third round of LTRO. We've got inflation now at 1.1%, which is far below the 2% target level for the ECB as part of its mandate. But they were also talking about how banks were undercapitalised and how any form of LTRO wouldn't replace this need for recapitalisation. So they're almost giving us this warm-up, as if to say, this warning, as if to say that in the next few months we are going to offer an LTRO, but it's no excuse for banks to go easy on the books. And I think from then we'll see much weaker euro off the back of this stimulus, but then we'll also we'll potentially have some tapering from the Fed, which is dollar positive, and then enter these debt ceiling talks, which again is dollar positive as well. So I think between 137.10 and 140 is going to be the limit, and from there on in, I think we're going to see a pullback to 132 to 130.
Yeah, but just to finish off quickly, a euro dollar below 130 doesn't really seem to be an option anymore. I remember doing these interviews a few months ago, and people were surprised that it had broken above 130, but that doesn't seem like that's going to happen anytime soon.
The entire mood around the Eurozone's actually changed, which is quite staggering. When, like you say, earlier this year, we were talking about, I think I mentioned the fact that we didn't even see the Eurozone exiting recession in 2013. It was going to be 2014 at the earliest, and that really was the market consensus around this, that people didn't really see any real upside for the Eurozone, and all of a sudden, at the end of the second quarter, the Eurozone exited recession, and everyone's mood had changed. The PMIs were coming out higher, the market, manufacturing services PMI readings were better, and all of a sudden everyone's a lot more optimistic. And now I think you're right, I don't see it falling back below 130. I think it's just going to continue in that 130 to 135 range starting earlier in next year.
Well, thank you to James and Craig as always, and this time you can at least hear the interview, unlike last time. But for now, goodbye.